Hey everyone, welcome back to the DeFi podcast. I'm the host of the Chain Reaction segment, Tom Shaughnessy, and today I have on Tascha from Alpha Finance. Tascha, how's it going?
Good. Thanks for having me.
So it's early here and late there, right?
Correct. We're in
Two different
Thailand.
worlds. That's awesome. Well, Tascha,
24/7 global market.
yeah, no, it's why we're here, right? Well, Tascha, tell us a bit about yourself and how you got started in crypto.
Sure. So I studied in economics at UC Berkeley, and I studied from traditional finance. So I worked in investment banking for a number of years in San Francisco and also in London. And then I pivoted to join Tencent as a product manager before I pivoted again to join Band Protocol as a head of strategy. So pretty much really dig deeper into how we can drive more Oracle adoption in various DeFi protocols. And then I actually saw there are a number of gaps in DeFi space. And I met Nipun, which is the co-founder, and we really agreed upon how we want to drive Alpha Finance forward. And the model that we're taking for Alpha Finance is quite unique and different from the other DeFi projects in a sense that we're not tackling one particular issue, but we're tackling multiple market gaps that we see because we think that DeFi moves really fast, and if we just stick to one problem, then it may not be what the market wants. So yeah, we agreed on the mission. So Nipun and I started Alpha Finance Lab, and that's how we got here.
That's awesome. Yeah, so when did you guys found Alpha Finance?
Yeah, so earlier this year, so around mid of this year, that's when we, became more public and also, share more about what we're doing. But then before that, we were more of, in stealth mode, working privately, really fine tuning the model that we really want to go forward with.
That's awesome. I mean, so rolling out a suite of apps like within the Alpha Finance ecosystem is interesting, right? Because you want to roll out a lot of products to fill niches, but on the flip side, there's no one like driving product. Like when people start projects, they're like, I want to offer, this. How did you kind of come to bear on, let's offer, a suite of products versus just one?
I think it came about when we were in stealth mode, right? We were studying DeFi market, very deeply, and then we came across there are a number of problems that we want to tackle. And once you dig deeper into the problem, you get stuck, right? So we shift among different problems at times, depending on what innovative ideas that we come up with. And then sometimes you actually get a solution that is a mix between, let's say, solution A and solution B that you thought of, and then you came up with solution C that actually solve a problem D, right? So I think that actually makes it a lot more agile and also something that keeps us innovative all the time. So it doesn't really hold and pinch us to one singular problem.
That's awesome. So your first product offering is Alpha Homora. It's for leveraged yield farming. My first question is, who's the Harry Potter fan? And then we can get into it.
Yeah, it actually is, our team here, they love Harry Potter, but we also got inspired by the, Alohomora, which is technically the spell to unlock door. So we twist that and make it a spell to unlock yields, which is one of the theme that we're working on, which is, how do you maximize yields? But not only that, another theme that we're working on is also how do we balance between maximizing yields and minimizing the risk and downside exposure? So a number of alpha products that will work together will actually achieve this overarching theme of maximizing yields while minimizing the downside exposure. And we think that's the ideal financial product suite, right? Maximizing the yields and also minimize the downside exposure. So with the upcoming alpha products, that should also work together to achieve this bigger theme.
Awesome. Makes a lot of sense. And how exactly does, so for those who are not familiar with yield farming, basically you supply an asset, the very simplified version is you get a governance token in return for supplying assets that help power a new protocol, things like that. How exactly do you take a leveraged yield farming position without Alpha Homora? Is there a way to do it today?
There is, but it's not exactly the same. So how you would do it is, let's say you supply collateral over collateralized as well. So let's say you supply 1 ETH and then you can borrow equivalent to 0.8 ETH. So it's under over collateralized, and then you have to take that 0.8 ETH that you already borrowed and then add it to the liquidity mining or liquidity providing pool along with another, more capital of your ETH, right? So let's say you have another ETH hanging like left over. So in total now you have 1.8 ETH. And then you supply it to Uniswap or SushiSwap or like Curve Balancer. And then you take that LP token and then supply to the liquidity mining pool. So let's say for Uniswap, then it would be, the 4 pools that they were holding for giving Uni. And then you would get Uni. And then once you get Uni, then you have to claim it yourself. And then you also have to, go through either you want to sell it for more yields. And if you want to sell it for more yields, then you have to reinvest it back. So convert it to ETH and then so there's so long process for that. So what Alpha Homura does is that you don't need to over collateralize. You're actually under collateralized because Alpha Homura is holding the custody of the assets. So it manages the assets for you. What that means is that let's say you have 1 ETH, right? And then you supply it into Wrap ETH USDT pool that we have for up to 2x leverage. And then you enter into, let's say 2x. So it would borrow another 1 ETH for you. So now you have 2 ETH. And then it would swap for you so that you would have, 1 ETH and then the equivalent another half of USDT. So you have equal value of 2 sides. And then it would supply to the AMM protocols for you. Once you get that LP token, it would automatically stake that LP token to the liquidity mining pool for you, so you can get the farmed token. And then what's also pretty neat is that once you get the farm token, there is this reinvestment function, which allows anyone at all who can come into the site and click reinvest. And the person who clicks reinvest would get 3% of that farmed token rewards. What they're doing and helping the users in general is that everyone who is farming in that pool is pretty much getting their position increased from that reinvestment function. So everything is all automated for the users, and the users just do 3 simple steps instead of 20 long steps.
Yeah, no, that was a great walkthrough. That was my next question. So I guess the TLDR on how you guys obtain the increased yield for Alpha Homura is that you attract people that hold Ethereum to lend it to your protocol, and then those entering into yield farming pools, they supply 1 ETH or 2 ETH, whatever their amount, and then they withdraw a multiple of that from your ETH pool, and then they use that as leverage in yield farming. Is that a good summation?
Somewhat, but the caveat is that they actually don't borrow and then have it in their wallet, and they have to do it themselves. But then once they, let's say, supply the 1 ETH and then they click 2x, Alpha Homura now knows that you want to borrow another ETH, so it will borrow on your behalf, and then it will take your funds and the borrowed funds to you farm or liquidity provide for you on your behalf.
That's awesome. Yeah, the automation is great. And so I guess one of the limiting factors here is just attracting enough ETH to your pool to enable that leverage. How do you attract ETH? Like you have to give attractive yields. So I guess how are you attracting people to deposit ETH? And is there any increased risk for the higher yield that these lenders take in?
So the first part to your question in terms of how we attract, in the beginning, we also supply ourselves to bootstrap the liquidity. And, once there is this demand from the yield farmers to increase their yields, then they would take the leverage. And by default, the ETH lenders would get high lending interest rate because there are these yield farmers who are borrowing on that ETH that are being lent out by the lenders, and they're paying the borrow interest rate, and they're willing to because they're getting the higher APY from yield farming, also from leverage on top. So let's say typical yield farming APY is, let's say 30%. And if you do 2x, then that's already 60%. And then there's also trading fees, let's say 10%, do 2x, and that's also 20%. So in total, that's quite a lot when compared to the amount of interest rate you have to pay for borrowing the ETH. So once we establish the name more, then more of ETH lenders are becoming, know of Alpha Homura as the place where you put your ETH. And interestingly, I think there are a number of projects trying to see how they can maximize the yields for their treasury as well. And we were talking to Andre, and then he proposed this proposal to Keeper Network community to find a way to maximize yields for the idle treasury. And pretty much they decided to move some of the treasury of ETH in Alpha Homora. So instead of getting a few percentage of trading fees while supplying to Uniswap, might as well get, let's say, 8% or even more yields on ETH on Alpha Homora. So that's the first part of the question. The second part of your question in terms of whether there is more risk when the yields for lenders are higher. Technically, the only risk for lenders are the lending risk, in a sense that utilization rate hits 100% and you cannot take out your ETH. So that's similar with the other lending protocols. And with the interest rate model that we have, we prevent from having the utilization rate be at 100% all the time. So as utilization rate increases, then the borrow interest rate would increase and the lenders would also get more, incentivizing more lenders to come in and decentivizing the borrowers to continue borrowing. So pretty much, I would say, even if the lending interest rate is as high as, let's say, 25%, which is what happened yesterday when the utilization rate was about 90+%, then the lending risk is still the same.
That's really interesting. Yeah, I like that your interest rate changes so that you don't hit that 100%. You don't want people to get stuck in the scenario where they can't withdraw. That would be terrible.
Right.
And yeah, so it's interesting. I guess the way you're driving the ETH yield is pretty interesting. I mean, is there a risk though that, like, what if one of these farms gets hacked? Like, is the Ethereum that lenders deposit at risk in some way?
So there are multiple ways that we minimize that risk. So number one is that we only offer leverage to the pools that have more, liquidity than the threshold that we set. And that means that these pools are less susceptible to price manipulation. So if you look into Alpha Homora, you would see, let's say ETH Pickle yield farming pool is actually at 1x. So there's no leverage on that. So when there was the hack with Pickle, there's actually no risk for our users. Or even, ETH MTA yield farming pool, we offer 1x for that because the price volatility is quite high. So we decided to not offer leverage on that. So we make sure that, the risk parameters are in place and the liquidity is high enough to not allow for that price manipulation.
That's pretty cool. Yeah. And I guess the cool thing about you guys, I'm just trying to think through this, is that as yield farming yields stabilize, so they go from, 1,000,000% a year, which is obviously not sustainable, to, maybe 10 or 15%, maybe 20%, that's sustainable for projects, I think. But on the flip side, you can then bring that back to a level that's attractive for users because you're providing that leverage and bumping that APY up to, 20, 30, 40% or more.
Mm-hmm. Correct. Yeah.
That's pretty interesting. Do you ever think that you guys will get to offer, 5, 10, 10x leverage? I don't want to say 100 because I don't want to, have BitMEX kind of rabbit hole.
So not for ETH, because we will run the analysis and given, the past price performance, we are comfortable with 2.5. And this takes into account the Black Swan event as well. So if another Black Swan event happens, 2.5 would be fine. But that doesn't mean that we're not going to offer more than 2.5 on any other assets. And that's just another hint for Alpha Homora V2 that we're going to offer, leverage on other assets too, which can go up to 10x.
That's awesome. That's exciting. And I guess just on the actual pools themselves, I think I counted 31 pools. How do you figure out which pools to add? Or sorry, 32 now. You guys added one since I did my DD, but how do you guys go about adding pools?
Yeah, so there are pretty much 2 to 3 strategies that we take on. The first one is that the pools that have, meet all the criteria, right? With liquidity and, price volatility is all fine. Then the yields would come pretty as a main important thing. If the pools are generating yield farming or farmed tokens, let's say like Sushi Swap or MStable, which is giving MTA, or like Index Co-op, which is giving Index, then those are more of the priority. And then if you look into another type of pool, which is called liquidity providing, so these are the pools that don't give farmed tokens. So for example, like ETH, YFI on Uniswap, they actually don't have any yield farming going on, but the trading fees is really high, like 100+% organically. So we also, prioritize those pools as well, even though there's no yield farming. And the third type is also the pools that have strong communities. So let's say like Chainlink, Aave, these are, I believe one of the top core communities, and we want to offer them another usage for their token.
That's awesome. And I missed something before when we were talking about incentivizing people to deposit ETH. You guys rolled out a partnership with Aave. How exactly is that partnership going? Because that plays into the question as well.
Yeah, so we saw there is a gap when people can actually borrow ETH from Aave and paying, let's say, 1% for borrowing that ETH. And if they lend that ETH to Alpha Homora, at least they're getting like 8%. Or let's say like yesterday, ETH utilization rate for Alpha Homora went to pretty high, then they can get 25%, right? So it's that arbitrage that we can offer our users or even Aave's users to gain even more. So let's say you already deposit on Aave, then once you come to our site, you would already have that collateral. So you can go to the next step, the second step to borrow the ETH from Aave, and then the third step to lend that ETH from Aave on Alpha Homora. So we just automate everything for you instead of having you to go through Aave's site, Alpha Homora's site, which, I mean, you can do it yourself too, but we just automate everything for you here. Or if you don't, or if you haven't, lent on Aave yet, then you can lend it through Alpha Homora and use that asset as the collateral and then borrow ETH and then lend the ETH. So pretty much it's a win-win scenario where we also get more users, get more liquidity for the leverage ETH farmers to take more leverage, but Aave also gets more lenders and also get more ETH utilization rate on Aave's side.
That's awesome. Yeah, it's a great way to incentivize people to deposit ETH. It's kind of like a one-click no-brainer for them. And
yeah, correct.
One quick question. I mean, a lot of people are in yield farming are concerned about like security and things like that. How do you guys handle that side of things? Have you guys gotten audits and how's that whole side of things?
Yeah, so PeckShield took security review for our site, for our code. And also the parameters that we set are something that we are comfortable with. So let's say that's why we don't do 3x, that's why it's 2.5. And this is why, particular pools have no leverage at all. So, each particular number has a reason for it. It's not just a random number that we decided to offer that pool. And also Alpha Homora V2 is coming up, and that is actually going through another audit right now.
Cool. And how exactly does the UI work for users? Like if I'm going on Alpha Homora to yield farm, and let's say I take out some, leverage, am I getting the increased governance tokens, say, straight to my wallet, or is it held on Alpha Homora somewhere and given up after? I guess just wondering about the decentralization aspects and the handoffs of the tokens.
So for Alpha Homora, the current version, the farmed tokens are aggregated as a pool, and then the reinvestor, who's someone else or anyone at all, can come in and click reinvest, and the benefits for them is the 3% of the whole farmed token in that pool. The cost for them is the gas fee, so they can weigh the benefits and costs, and if it makes sense for them, then they would do it. And then after that, the farmed token would be sold to ETH, and then repeat the whole process of supplying to a liquidity providing pool, supplying to liquidity mining pool, getting the farm token. So technically, you are actually getting increased position value automatically. So that's why you're not actually getting the farmed token, because these farm tokens are being reinvested by the reinvestor for you.
Got it. That's really cool. No, Alpha Homora is awesome. And your UI and UX is just so easy to use. It's refreshing. This is great. And
yeah, that's something that we care a lot about.
Yeah, and just one last question here, just on the risk and kind of like an attack vector. If you want to deposit ETH, right? Like, wouldn't there be an incentive to go into the riskiest pool on Alpha Homora because you kind of have that pooled ETH backstop where like everybody's ETH is kind of at risk, or is it siloed per pool on the ETH deposits? I guess I'm just wondering, like, if a pool gets hacked, like, And if everybody else is backstopping me, I kind of have an incentive to go as risky as I can on Alpha Homora.
Correct. I mean, the ETH pool that's lent out, they're not, proportionate to, this is only the portion for this pool and this is the proportion for that pool. So in a sense, it's all shared. The downside for you to take the riskiest pool is going to be, impermanent loss. So let's say if you go for the pool that has really high volatility and you want to take like 2.5x, then you may actually not earn at all. You might lose from that impermanent loss. So it's something, and impermanent loss is probably gonna happen before, or even, first before the attack, if the attack were gonna happen. So I think that's something that, the EU farmers would have to take into account if they want to be really risky.
That's really interesting. And for those new to impermanent loss, it's a tricky concept, but it's just the value of holding your assets versus the value that you would get by depositing in a pool. Just the difference in what those LP tokens are worth. And so the impermanent loss is magnified then by like 2 or 2.5x. Okay, that's interesting. Yeah, it's definitely a disincentive to go ultra risky.
Correct. But
that's pretty cool.
A side note for special DeFi podcast listeners, which we haven't shared with anyone, it's actually we're working on a new concept, which will be more on the impermanent loss insurance. So now that impermanent loss has always been the back of the mind of everyone who is looking to provide liquidity. And now with leverage liquidity providing and leverage yield farming, the impermanent loss is amplified. So we actually came up with a new idea to actually offer an insurance for impermanent loss. So we're working on the detailed model for that, algorithms for that, and to make sure that we have solidified the initial idea. And then once we do, then we're going to share more with our community.
That's awesome. Yeah, no, that's going to be super interesting. And I guess on new products, you guys are also launching AlphaX. Let's dive into that. I don't know what to give away or what we should dive into first, but what's interesting about AlphaX?
Yeah, so AlphaX is something that we decided to build as well from the market gaps that we saw from Alpha Homora. So link back to what I said earlier in a sense that, there are a number of problems, a number of market gaps that there exist in DeFi. And once you launch one thing, you would see more market gaps from it, which you may not see without launching that product. So once we launched Alpha Homora, we actually saw that there's a lot of demand to take and really enter into market neutral leveraged position. So by taking a leverage on Alpha Homora and you borrowing ETH from Alpha Homora, by taking that leverage, you are somewhat exposed to the short position of ETH, because a part of that ETH would be sold into another token. So you have both of two assets to supply to the liquidity providing pool, right? So when that's the case, then there are a lot of people who want to still take leverage on Alpha Homora, but they want to take the opposite long leverage of ETH elsewhere. So when we saw that, we actually thought, okay, we were thinking of offering this as another strategy on Alpha Homora, but instead of just limiting to just ETH asset, we decided to not limiting to just ETH, but expand it to any asset. So this became the whole new area of perpetual swap, which we decided to look deeper into that. And it's just really amazing and interesting area where the market gaps are so huge and there's no major player in the DeFi space yet. So we came up with a very unique and innovative design that is super different from the other solutions out there. We will continue to share more in details in terms of how is it different, but on a very high level, there are a few features that I can talk more now. So first is that we actually baked in the concept of funding rate into the quoted spot price. So that means that the traders who trade on our perpetual swap market or AlphaX, you don't have to worry about funding events. You don't have to pay the high gas fee for just that funding payment, because everything is baked into the price. So the only thing that matters for traders are the entry price and the exit price. So that's a lot easier on the trader's side. The second thing is that the leveraged long and short positions are actually tokenized. So it will be something that you can use as collateral on other protocols, it will be something you can trade on secondary market. So, you know, it expands the whole innovation arena to a lot more because of this tokenized long short leveraged position.
That's super interesting. So just the TLDR is like a perpetual contract is similar to a futures contract, but there's no expiration date. And I guess the idea of baking in the funding rate into the spot price is pretty interesting. Can you describe exactly like what the funding rate is today? I got to brush up here, but I'm pretty sure that it's that one side pays the other side to come back to some spot price or nominal price.
Yeah, because perpetual swap markets are, you know, separate from the actual markets. Let's say you want to lever up on ETH 10 times, for instance, and the price of ETH on the external exchanges, maybe, you know, various exchanges is at 600, and the price in your perpetual swap market is at, let's say, 550, right? So in this case, you have to have this concept of funding rate to make sure that this price will be moved up to match or at least towards the 600, which is the target price that you're tracking. And the funding rate, how it works is that if the price in this perpetual swap market is lower than the external target price, then those who are taking the short positions would have to pay the long. So pretty much incentivizing more long traders, decentivizing short traders, and as a result, moving the price up towards the 600.
That's cool. Yeah. So the funding rate just basically like an automatic incentive for one side to pay the other to go back to like a quoted spot price. And I guess I might be getting ahead of myself here, but if you bake the funding rate into the price, there's no like ongoing payment from one side to the other, right? Because that payment from one side to the other is at the initial buy. Does that introduce a problem of like this price might get away from the spot price because you don't really have that ongoing incentive, or am I thinking about that wrong?
Because the ongoing incentives are actually baked into the price. So how it works is that, let's say if you were to close the position, let's say you're long ETH right now, and the price in our market is 550, and the price in the target, you know, spot price is 600. How it works is that if you were to close a position now, the long position holders would get a higher price than if you were to close, you know, a minute before. So technically the short is paying the long, but they don't have to go through paying the gas fees for that settlement of, you know, tiny amount of money.
That's pretty cool. And the fact that you're tokenizing these is pretty cool. Where do you think that these will be used? Like, you think that these will be used as collateral, or?
I think it's really interesting. I think we're gonna see a whole lot of innovation that comes out of it. I think a number of DeFi projects will find more use cases from it because, you know, this is the first, or like one of the first few times that we're tokenized these leveraged long short positions. How we're thinking of it as the beginning is that we're gonna have the secondary markets so people can trade these positions, and then we will continue to work more with other DeFi projects that, you know, are as excited as this with us, and then we can find more use cases with them, perhaps through collateral, perhaps through even new use cases that DeFi comes up with.
That's awesome. And one of the features that you had, like as a notable feature, is just a non-manipulable price feed. How do you guys achieve that? And thank you again for the crash course on this. This is super interesting.
No worries. Yeah, so we are looking to use, Keeper and also Uniswap. We're comparing the two right now, TWAP. So it's something that actually is a lot better in terms of less susceptible to attack. The downside of it is it's not updated as real time. So we're adjusting the parameters such that the pros and cons are balanced out. But how we think of it is that, you know, the risk for attack is more of a concern than the price not updated as real time. So this is more of, you cannot optimize for everything. So we're adjusting the parameters to a point that it's something that we're comfortable with.
Tascha, crypto expects you to optimize for everything all the time. It's impossible. This is no, Alpha more is great. AlphaX sounds awesome. And just to tie this all together, let's talk a little bit about the Alpha token. How does the token play into the ecosystem?
Yeah, so token will continue to be more and more important as we grow. So we still consider ourselves as pretty early in our timeline for sure. So with the current usage of token, right now it's purely governance. So users can vote on different parameters that we adjust. Let's say the interest rate model that we just adjusted for Alpha Homora. That's something that the community voted to change as well. But then when we launch AlphaX, we're also going to bake in the concept of security token, which is similar to how you would stake the token as an insurance or even like first line of defense when positions become underwater in exchange for the protocol fees. So in this case, we'll be in exchange for the trading fees. But then we also came up with two other types of tokens that we are going to implement in the future. So the first type is called work token, and the second type is called interoperability token. And all these are all the usages of Alpha, right? And how we think of work token is that once you use Alpha Homora or even other Alpha products, if you have Alpha token, you can use it better. So let's say if you don't have Alpha token, you can open up to 2.5x. But if you have Alpha token, you can open up to, let's say, 3 or 3.5x. So you can actually use the product better if you have Alpha token. And we're looking to implement this in the future when we achieve more and more adoption and it makes sense to implement this functionality. And then the last one is the interoperability token. And what that is the fact that we're launching a number of DeFi products, and all of our Alpha products will interoperate and bring synergy to each other. So if you have Alpha token, you will be able to use that interoperability better than if you were not to have Alpha token. So for instance, if you take 2x position on Alpha Homora and you want to take the opposite long on ETH position on AlphaX, if you have Alpha token, you would be able to do that in one click through the front end. But if you don't, then you would have to go through AlphaX and do all the processes yourself.
That's awesome. Yeah, no, it makes sense to have the token play into every different aspect of the project. And when you're talking about all these apps and where the token plays in, it's a lot to bite off, right? How do you guys handle that? Like, how many developers do you guys have? Like, how do you handle paying them? Like, it's a lot of work.
Yeah, so right now we have 6 developers, quite a small team, and we're recruiting. So if anyone's interested, so even though the core team is based in Thailand, but we're actually recruiting globally. We're talking to developers in the US, in Vietnam, in Malaysia right now. And how we're paying them, it comes from 2 things, right? Monetary is one thing, but passion is another thing. So we recruited the core team to be someone who's really passionate about DeFi and like this fast pace of working. But of course, monetary is important. So we also pay in bonus and in Alpha token with vesting schedules and all that.
That's awesome. And so Tascha, just to round out, I try and think about these things like in the face of like Yearn, and I think what you guys are doing is awesome. Like you're releasing much needed yield farming and DeFi type use cases faster than anybody else that fill niches. I guess the question for you though is like, and that's awesome because it's a whole suite of products that flow back to your token. I guess my question though is like, how do you feel though about competition? Like when you're looking at a Yearn, like obviously you could potentially move faster than them. I hate to say it because Andre works like 50 hours a day, but you guys could potentially move faster than them. But on the flip side, you may have like a suite of like a zillion products that might eventually be hard to keep up with. Like, how do you kind of think through just building the suite of products, but also staying ahead of other projects?
Mm-hmm. So I think there are multiple things. Number one is, of course, we can take on more ourselves. But what we're looking to do more is also encourage the community to help contribute with any kind of contribution that they can. Maybe it's writing or doing graphics to show how Alpha Homora works. Maybe it's writing code. So I think we're going to bootstrap our community more, so that as an aggregate we're working on this together and not just our core team. So that's one thing. Another thing is that we don't think of Yearn as competitor. I think I actually look up to Andre and also look up to how Yearn works. And I think the more DeFi projects that adopt this kind of way of working like us, the faster DeFi is going to innovate. So as an aggregate, we're all working together to help bring DeFi to more usages, right? So even when Yearn is acquiring and merging with a lot of protocols, I'm talking to Andre on a daily basis, and we're always finding an angle of how we can help, or even how Yearn can help Alpha with different models and different products that we're building. So I think it's going to be interesting in a sense of we will not see a competition in a way that, this is Alpha ecosystem, this is Yearn ecosystem, but we're going to see like a huge whole ecosystem that, we cross among each other. And then hopefully more protocols will join our huge ecosystem.
That's awesome. Well, Tascha, this has been incredible. I love what you're building. I love the suite of products, building fast. I love building whole ecosystem, and that all flows back to one potential token, which is awesome. And I'm amped for AlphaX. So where could people kind of find out more about Alpha Finance if they're interested, and even potential developers if they're interested in working with you too?
Yeah, so if you want to follow Alpha Finance, Twitter would be a good place. So Alpha Finance Lab on Twitter. And on the Twitter bio, there is also a link for Telegram and Discord and our blog. So you can read all day about our blog. And for developers or anyone who want to contribute to our community, you can directly reach out to me on my Twitter as well. So it's Tascha, TASCHA_PANPAN.
That's awesome, Tascha. Thanks so much for coming on. I'm going to link to everything you mentioned in the show notes.
Okay,
People could scroll
awesome.
down, check out Alpha Finance, check out you. And thanks so much for coming on. I know it was kind of late there.
No worries. Thank you so much, Tom.